We got some great news for Upstart stock investors today. In fact, we got a double dose of great news for Upstart stock investors today as the company announced a $2 billion loan agreement with a buyer that will help facilitate more loans on the Upstart platform. The stock price was up more than 16% as of this recording following these announcements. So in this video, I'm going to share with you the details of the announcement, what actually was announced, and then connect it to the share price and why the stock price increased as a result of this announcement and what it could mean for Upstart stock investors. So let's take a look at the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so if you're not familiar with Upstart, it's a leading artificial intelligence lending marketplace. So it makes loans based on artificial intelligence. It uses AI to evaluate borrowers to determine how much money they should be approved for and at what interest rate, at what duration, etc., instead of using human evaluators for those loan applications, which could be more costly to evaluate and which could deliver lower metrics, lower performance metrics, meaning those loans could underperform if they're evaluated by humans versus artificial intelligence, because the theory goes, according to Upstart, that AI is better at making lending decisions. It can evaluate more variables and make better decisions based on those evaluations compared to the traditional lending model, which is based on the credit score and people evaluating those inputs like your job and your income and your pay stubs and your IRS tax returns, etc. So this AI lending model has yet to be proven, and it's a risky business because it has yet to be proven. And the reason it hasn't been proven yet is because there isn't enough data, especially data with regard to recessions. When you're making loans, you can't really determine what the performance of those loans are until you go through a recession. When you go through a recession, then you find out what percentage of those loans are going to default. That's when the defaults start to present themselves. When the economy is going really well and humming along, people are getting jobs, getting promoted, incomes are rising, there's very little default activity going on. However, when you enter an economic recession, people are losing their jobs, promotions are less found, less available, and so people that were over leveraged, they really start to default on those loans when they lose their job because they weren't saving enough or they borrowed too much, they didn't plan well enough, etc., etc. So that being said, let's get into the details of the announcement. The company saying that Blue Owl, an alternative credit strategy company, will purchase up to $2 billion of consumer loans on the Upstart platform over 18 months. The transaction includes an initial purchase of $290 million in personal loans, which closed in September. And the Blue Owl company, saying that they are excited to support Upstart's efforts to make consumer lending process dramatically more efficient for borrowers and lenders. So in response to this news, Upstart's stock price is up over 16% in response to this news. So it's a big deal. And let me explain why that's the case. So if we look at Upstart's balance sheet, this contains the data on the value of loans that they own on their balance sheet, meaning if those loans default, then it will be Upstart that loses the money. And initially, this was not what Upstart intended. Upstart did not want to own any significant amount of loans on its portfolio. It wants to be a marketplace. It wants to bring together borrowers and lenders. It wants to utilize its AI model to make those decisions and then have lenders make the loans and borrowers apply for the loans, and Upstart to just be a middleman in the whole process. The way the company wants to make money is with its AI model. It wants to use AI to evaluate those borrower applications and then have lenders evaluate the results of the AI outcome and make the loans themselves. But in late 2022 and throughout 2023, lenders pulled back from the platform. They were concerned about an oncoming recession. And when you're about to enter a recession, as I highlighted in the beginning parts of the video, that's when loans start to default. And of course, as a lender, that's when you want to pull back. You don't want to make loans when you're about to go into a recession. And so that's what led to a pullback from lenders on the Upstart platform. And Upstart had a choice to make. Either it was going to turn away all those borrower requests, because borrowers were still coming in and saying, we still want to borrow money. Lenders were saying, no, thank you. We don't want to lend you any money. And so Upstart said, you know what? Fine, we'll do the lending. We'll use our own money and make the loans and then hold the loans on our balance sheet because we're confident in our AI model. We're confident that these loans will outperform compared to the risk that we're taking. And so Upstart's loan portfolio increased to amounts that they didn't want initially, right? As of the first quarter of 2024, their loan portfolio had risen to $1.1 billion, which is roughly $1 billion more than Upstart intended to have on its balance sheet. This makes the business much riskier because if those loans start to default, it will be Upstart that loses that money. So now not only do you have the risk associated with the AI lending model and the unproven nature of that model, you also had the risk of financial liability from loan defaults. And so that just exacerbated a company that's already risky because of the innovative nature of the lending model. And now you see this loan portfolio starting to decrease as lenders are now not as afraid of a recession. We've gone through 2023 at higher interest rates. 2024, especially since the middle of 2024, interest rates have started moving down. The Federal Reserve just initiated a 50 basis point cut in interest rates, and it looks like they're on the path to start lowering interest rates. And so the biggest probability of a recession in the United States, at least, we've kind of avoided. We've avoided the biggest probability moments of a recession. Now, there's still a chance of a recession, but those biggest likely outcome of a recession, which is when the interest rates were initially jolted higher by the Federal Reserve in late 2022 and early 2023, that's when the fears of a recession were the highest. And now it's kind of decreased and diminished. And so that's great news for a company like Upstart. And now with the announcement today, what it really is evidence of is lenders saying, you know what, we're feeling more comfortable that a recession is behind us or a potential recession is behind us, and we can go into the market and start lending again. And we got further evidence of that from SoFi also. SoFi made a very similar announcement this morning saying that they agreed to sell $2 billion of personal loans as well. So these, like I said in the beginning of the video, we kind of got a 1-2 punch, positive, good news for Upstart, because this again reiterates that belief from market participants that the recession is behind us. Lending activity is increasing, which is great news for Upstart because its whole business model relies on being a marketplace. Lenders and borrowers. Borrowers have stayed, right? There's never a shortage of people trying to borrow money. Believe me, you go back 1,000 years in history, 2,000 years in history, and you go forward 5,000 years in history, you're never going to find a shortage of people that want to borrow money. What is in shortage is qualified people that want to borrow money, businesses or people, and lenders that match with those borrower interests, right? You've got to find good prospects to lend money to. If you just lend money to anybody that wants to borrow money, you're going to miss out. You're going to lose a lot of money in that endeavor. So if we look further into the balance sheet, the combination of loans that Upstart owns, you can see now the total on the balance sheet as of the second quarter of 2024 was down to $821 million. Of that total, $294 million was auto loans, which are not as risky. Auto loans are nowhere near as risky as personal loans because if people default on their auto loans, the company can go repossess the car, sell the car at auction, and recoup the significant majority of the money that was owed. What is more risky is personal loans because there isn't anything you can recoup. And so by agreeing to sell the personal loans, Upstart really lowers the risk of the business, significantly lowers the risk of the business, and indicates this market is opening up, which could have positive impacts for SoFi longer term. So that's why it's really good news for Upstart stock investors. I may have said SoFi right now. Forgive me. I just did a video on SoFi, pretty much saying the same things here. But for Upstart, it's even more meaningful because this is a larger importance factor for Upstart than it is for SoFi. SoFi's business is more diversified. It has other areas where it generates revenue and profit. For Upstart, this is it. This is their whole business. And so for them, it's a much bigger deal. And you can understand SoFi stock was up only 10% today, following a very similar announcement, whereas Upstart stock is up 16% because it's more important for Upstart than it is for SoFi. So really great news. Congratulations to all you Upstart stock investors. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.